Recording is on.
Hey everyone, it's Casey Stubbs with the How to Trade It podcast, and today I am here with Tim Ord from the Ord Oracle, which is an award-winning newsletter about market timing, and he also is an author and many years of experience. Welcome to the show, Tim. Thank you for being here today.
Thanks for having me, Casey. Glad to be here.
So I always like to start the show out by asking people how they got started, and I'm always getting people with a lot of experience like yourself, and it's always just fascinating to me to see how people get started in the markets, especially someone like yourself, because I think nowadays the markets are a lot more accessible, a lot more open to people to get started, because there's internet, there's online trading, there's education online, there's all this stuff. But back when you got started, it was more, it was a little harder to get in, I think.
Yep, it was. Matter of fact, I got in. Make a long story short, I was a math major in college. I graduated from the University of Nebraska, so numbers always made sense to me. And anyhow, I got into the brokerage business in 1977. They didn't have the internet back then. They did have a couple of market letters back then, very few. One was Joe Granville, and another one was Stan Weinstein. If you're a young whippersnapper, you probably don't recognize those names, but those names back in the 70s and 80s were the pinnacle of market letters at the time. And I took those guys' market letters and totally just fascinated me, just because back in the day in 1977 when I got into business, technical analysis was really taboo. They thought it was it was hocus pocus. The only thing you really should do is do the fundamentals. And I was working with my first brokerage business firm was Dean Witter. They were the big three. Dean Witter, Merrill Lynch, and E.F. Hutton were the big three brokerage firms back in the 70s. And Dean Witter, again, was just, they wanted fundamentals. That's the way to go, how to buy and sell stocks through fundamentals. And again, I was a math major. I'm thinking that's didn't really fit my forte. But when I started to read Joe Granville and Stan Weinstein, which were a lot more, they were technical back then. They did moving averages. They didn't do any earnings projections or anything like that. They were all sentiment type things and climatic bottoms and all that stuff. And that's where I started to learn about technical analysis. And moving forward, back in the early 80s, I got hired by another firm, and I was the vice president options principal. And I started an internal market letter in that brokerage firm. We weren't a huge brokerage firm. We had about 200-300 brokers nationwide, and they wanted to hear what I say because I was kind of the technical analysis guru of that firm. So the brokerage firm asked me if I wanted to write a little market letter. Actually, I didn't write it. What we did was we had a answer machine, and I put my spiel on that answer machine, and the people of the other offices would call up the answer machine, and when they dialed it up, they got my update. And so that's how I got started. And I used to update. I did that for 3 years, and eventually I started to work at the brokerage firm, and kind of on the side, I started a little market letter. Didn't really have a huge following because we didn't have the internet back in. Well, we did, but it wasn't really. What do you call it? Wasn't really available to the most people.
Right.
So that I kind of started that way. Had a few clients, and as the internet grew, I grew with it, and that's pretty much how I got into business. But to me, technical analysis makes sense, and it's a lot more dependable than fundamental analysis. So that's kind of on the wayside now. So that's kind of how I got into the business, and been doing this since officially since 1989. So I've been through a few bear and bull markets, so I've kind of more or less seen it all.
So what do you think is the most important factor that's helped you survive for this long period of time? Because, you know, in the 70s, all the way 70s, 80s, 90s, 2000s, 2010s, a lot of different bear markets, a lot of bull markets, a lot of crazy stuff has happened in the world in that amount of time. So how have you been able to just be consistent for that long period of time?
Actually, I started back doing kind of a ticks and trend thing. We didn't have like quote machines you have now. And what I noticed when the market would, decline or even crash, I noticed that the ticks, all my, a lot of my technical stuff has climatic indicators to them. So what I found out over the past, when everybody's going to the exit door, I came up with readings to buy those people are selling, and I come up with the ticks and trend. The ticks is when they go climatic, that's usually close to a low. When and when the trend gets up around 1.5 or higher, that's close to a low. So I figured out through the years. Didn't really read it in any technical analysis books, but my work is predicated on panic. And the more panic there is, the closer to the bottom you get. So matter of fact, just recently over the last couple of days, I'm getting a lot of panic readings on the markets here. So evidently there's a low right around here. So.
Okay, so that's a pretty interesting factor. So you're saying that you have a panic indicator, and right now you're seeing people are panicking.
Right.
And so you're saying that means a low is coming, and you think we could get a bounce here soon?
Well, actually, the panics is actually kind of extreme across the board. So it's just more than just a rally. It's probably a trend change. We've been, correcting since basically early September, and it looks like to me we're probably that correction has been up and down, but it looked like we're finally getting into a low area where an near-term rally may start to occur here. And a lot of times, elections, which is next Tuesday, excuse me, normally if you're going down into it, you pivot to the upside. If you're going up into it, a lot of times you pivot to the downside. But since the market's kind of weak here and we've got panic readings in the ticks and trend, most likely it's probably going to be a low right around the election, so we're 1 or 2 days away here.
So yeah, that's actually a really good observation. I think that the election could be a catalyst for something, especially if I think the market's kind of just paused right now trying to figure out what's going to happen. They just want to get it over with so they can, get back to
move on.
Business as usual, right?
Here's an interesting thing. Normally, if the market's up from August to the election, which it is, normally the current president will stay president. If the market's down from August to the election, then there's a change of leadership. So according to the markets predicting Trump. This is, I'm not political, but I don't care which way we go. But the markets right now, as it sets, we got a couple more days to go, but it's predicting Trump will be the president because it's not declining.
Do you have any kind of data to tell us how often that is actually right?
Yeah, it's been right 100% of the time going back to 1940.
Oh my goodness. That's
a
pretty good indicator.
This time that's pretty good. So this time could be different, But.
It's the thing about statistics and trends. There's always that anomaly, but you still never know what's going to happen.
Right. So.
Wow.
But the market can still decline here quite a bit, but it's going to have to decline quite a bit to have that turnaround. So I thought that was kind of interesting, but time will tell.
Yeah. So I do a technical analysis as well on a lot of things, and I do look at the S&P 500, and I was looking at the 319.50 level as a potential place that could stall the down move just because of some support and resistance levels there.
Oh, the previous low.
Yeah, the previous low is what I was looking at.
Right.
What other types of things do you use to determine timing? Because I think timing was got to be really critical. If you can get your timing down for trades, that can really help you be successful in your trading.
Right. Well, I wrote a book called Secret Science of Price and Volume. So I do a lot of stuff in volume. If you notice, yesterday, if you look on the SPYs, you had a big spike in volume. And a lot of times you get those spikes where they just kind of stand out as the market's going along. They kind of just stand out like a finger. And we had that yesterday. So if volume doesn't really increase today, then we got some sort of a low yesterday. Will actually be low today because you actually made a lower low today. So I do a lot of climatic volume type things. When the volume gets way out of whack compared to what's average over the last 30 days, a lot of times you get trend changes. And yesterday was a climatic volume because volume jumped about 30% compared to the days before. This is on the SPYs. So yesterday appears to be an important day. If you look at GDX, we had a actually, if you look over the last several months in GDX, if you look at all the spikes in volume, there happened to be turnaround days. And so, and yesterday we had a big spike in GDX where it jumped about, I eyeball here, over 200% from the previous day. So that takes all the energy out of the market when it throws itself down, and energy really comes in, which is volume. That seems to halt whatever was going on. If it's going down, it'll halt to the downside. If it's going up, it'll halt to the upside. So this is kind of going to start to be an important area on both markets here.
Okay, so that volume spike, I was just looking at the chart as you were talking. There's a volume spike on the GDX and the S&P. And so just to try to grasp my mind around it, if we're in a down move, and the volume's slowly increasing, but then all of a sudden there's a really big volume spike like there was yesterday. That's an indication that the move is starting to get tired. It's wearing out. It's a climax type thing.
Yeah, it's an exhaustion moves. It doesn't generally, if the market's going down, then the volume's actually halfway keeping probably even or a little bit higher. But if you see big spikes, those are energy surges, which stops whatever is going on. If it's going down, it stops the downturn. If it's going up, it stops the down. If you look at GDX, matter of fact, going into that last high in August, you had a big spike up, and then you went to a big spike down, right into the mid-August low there. You had another spike. And if you notice, the market reverses.
Well, I'm just looking at it. So on August 11th, the market on the GDX went down quite a bit. It went from 45 to about 38. And then on the 11th was when there was the big spike, and that was the low. And it bounced quite a bit from there.
Right.
And then yesterday, we had a pretty nice spike, which is the 28th of October for people listening to the podcast 3 months from now or a year from now, 28th of October 2020. So you can go back and look at your charts. There was a big spike, and today is up a little bit. So this could be a signal of a turnaround.
Right. If you notice, if you have a big spike in volume, a surge, normally, if they're not, put it this way, all volume spikes are at least tested. As long as they're testing a lighter volume, that implies reversal. If you look at the August, 11th low, that wasn't tested until about a month later. If you notice that. And a big spike again, and that spike in volume was lower than the August 11th low.
Right.
And so that's bullish. So to break through a previous low, the volume should be at least equal or higher to keep going down. Well, it couldn't do it. So the volume is lower. Then it had a test. That second spike had a test on lighter volume, and that was another short-term bullish signal. And now today, we had a big spike yesterday, and the volume today, if it's lighter than yesterday, in other words, it didn't have energy to keep pushing down through that previous low, which is yesterday. If we can't take out the previous low, it'll attempt to take out the previous high. So would actually give an upside target to the previous high of, eyeballing here, that's like about 41 or something. So I hope that's not too confusing.
Well, no, yeah, it's we're having a discussion and we're trying to visualize without having the chart. I have it in front of me so I can look at it, but people listening aren't going to be able to hear it, so we're trying to describe it for them. So, Tim, knowing this volume spike is a really cool tool, and I have actually not. I've just learned this right now, so I'm really excited to talk to you because this is another tool in my tool bag here. So this is good. How do you take advantage of this to profit?
Well, actually, I bought today. We gapped down a little bit. I bought options. I bought I think it was November 20th, 40 options, strike price 40. So if I'm right, we go back to at least 41. I'm thinking actually we're not going to go back to 41. We're actually going to break out. If you notice on GDX, we've been actually consolidating since early August, really not moving very much at all. Up, compared. We're in a consolidation phase since the early August highs. We're going to break out of this consolidation phase at some point. And I'm thinking this is probably the last selling climax in this consolidation phase, and we're going to move up higher past 41, possibly much higher, probably in the low 50s. I'm thinking.
Okay, so this is good stuff. Is this the kind of is this the kind of stuff that your newsletter people get on a regular basis?
Yeah.
Yeah, this is good. So for everybody that's listening to Tim and I talk right now, you guys are getting some really actionable trade ideas. And of course, the trading is risky and all that stuff, and you have to manage your risk and all the disclaimers that you need to do. Anything can happen in the markets, but this is really good actionable training here for you guys that are listening and watching it on live. So you primarily focus on gold, and the GDX is the gold miners ETF, and the S&P, and you really stay focused just on those two areas, really?
Right, I do. That's my market letter, because I do a lot of stocks, but I've tried that in the past with my market letter. It just gets too confusing to people, so I just do the ETFs pretty much, and let them decide if they want to buy a stock in that industry or not. Or they can buy options. But my timing is usually, because I look a lot of climatic stuff in my indicators. So when everything's blowing out, I usually get pretty clear signals. The times I don't get really clear signals is times when nothing really blows out. And over the last several months, GDX with its big volume spikes to the downside, life's been fairly good because they're easy to identify. Because you got to have volume at least on the GDX, preferably 100% compared to the days before, to signal a climatic move to the downside or upside, where the S&Ps just need about 30% spikes higher than the previous days. So, yesterday was an important day on both markets here. So.
Okay, and so with that being said, there is technical, and I am in agreement with you that the fundamentals are not as reliable personally,
right.
But we do have the election coming up. So would you, that could be a game changer, or it could cause a lot of volatility. Would you have any recommendations on how to stay safe with this upcoming election for next week?
Well, the elections, it's a tough call. We're probably not going to have really runaway markets. I mean, they could right before an election. So I'm thinking whatever rallies today comes, it may go quiet here tomorrow and Monday, but it's only 2 days away.
Right.
But the indicators are suggesting that we're at least building a base on both markets, that's including GDX and the SPYs. And the Trend also had a panic reading here a couple of days ago, 2 days ago. So we got panic in the S&Ps. A lot of times, at least for this year, I noticed GDX and the S&P's been following each other. If one panics, the other one panics. And so a lot of times in the previous years, sometimes the market would decline, GDX would rally, and the SP would advance and GDX would decline. This year's they've been lockstep together. So both markets are kind of confirming that there's some sort of a low building in this vicinity. So, but that may change again next year, but just an
Right.
observation.
So that's a market correlation, and those can go together for some time, but then eventually they will separate and go their own way.
Yeah, separate and go their own way. This year they've been lockstep together. And
Yeah.
why, I don't know, really don't care. But as long as you observe that, then so I'm thinking both markets here are getting ready to rally. And I think the GDX market, I'm not really a great expert in Elliott Wave, but I've been doing it for about 30 years. But it looks like we got one more major impulse wave to the upside on GDX and the gold market, which may, excuse me, top out maybe sometime in February, March of next year. So it could be a good market for that for the next several months. That's how I'm looking at it.
Well, I've really enjoyed learning about your volume spike and the panic and finding out when markets are exhausted. Tell me a little bit about what readers of your newsletter could expect to get. What type of insight and what are you deliver to them on a regular basis?
Actually, most of my readers are there's a lot of money managers. I say that's probably about 80% of them. I mean, I do have individual investors, but it's on the educational stuff. What we talked about, this volume spikes. I put that in my market letter. I put a lot of different technical stuff that I've learned over the years into the market letter, and I point that out on charts. So most, I don't know which way I'm right brain or left brain, but to me it's all visual. So a chart tells me a lot more information than reading a paragraph about something.
Right.
So all my indicators are reference, or all my words are referenced to the chart. Look at this. There's a big spike, and I got an arrow pointing to the spike in volume, whatever. And the trend, I go back and give examples. Okay, when this happened, this is what happened in the past. So a lot of my indicators are referenced over the years. A lot of times I'll do the percent. When this happens, 42% of the time this happened, or 88% of the time this happened. So I got a lot of statistics going back in history compared to what was happened in the past. So markets do a lot of times repeat the same thing over and over again. When it becomes irrelevant, when everybody recognizes it. So I always try to use indicators that nobody else is kind of using.
And what type of indicators do you use on your chart? Volume was one, but is there anything else that you use?
Yeah, the trend. I use a lot of panic stuff, climatic type readings. When the market's pretty steady, not saying a whole lot. A lot of times those happen in trends. You don't get too excited to the upside or downside. That's probably when the market's trending. When the market starts getting lopsided, you'll start seeing euphoric readings and different indicators, and that's usually euphoric. You're looking at a high, price and volume type things. And if you're panicking, you're looking at a low. If you're panicking up and down, you got a trading range going. And that's what kind of GDX has been doing here, is kind of been panicking, a little bit of panic up, you get a top, you get a panic low, volume surges. So I'm thinking this next rally in GDX, you're not going to see a euphoric move right off the bat to the upside. It's probably going to be a impulse wave, which would suggest there's not going to be a lot of euphoric readings going up.
Okay, and how often do you publish your newsletter?
my market letter comes out Monday through Thursday, and it's 3 pages, but those 3 pages have big charts on them. So I write about a paragraph. So it's basically 3 paragraphs, and it all points to the chart. And it comes out about an hour and a half after the close on Fridays. If I don't have a signal, either to close out the long or whatever it is, if I don't have a signal, I won't publish anything. And if there's a signal, I'll put out a brief email saying I sold or bought this position and give a brief reason why. Then on Monday, I'll update the reason why and show the graph why I did what I did. And that's what I do.
Okay, well, I think there's a lot of coverage there, and I think with some of these setups that you talked about today, you could be some really good setups. How can Oh, go ahead.
I do have a book called The Secret Science of Price and Volume, and a lot of those indicators are in that book.
Right.
You can find it on Amazon, or you can write me. I do. If you want a signed copy, it's on my website. You can buy it there.
Okay, so would you recommend if someone was going to subscribe to your newsletter that they get the book along with it so that they can really get a more in-depth understanding of your trading methodology?
No, because I actually, the book's fine. I mean, it gives you a blueprint what I do. I added some stuff. That book was written back in 2008. I think I added some stuff to it. But my market letter is pretty educational. It shows you the reason why I did something and points it out on the chart. And a lot of times I'll give statistics to, this signal's done this in the past type thing. And I don't just have a one method to do it. I layer indicators on top indicators. So it's not one indicator giving a signal. It's 4 or 5 indicators coming together to give a signal. So the more, I guess, stuff you get to qualify the signal, the more accurate it'll be. I'm not one-dimensional. I'm 6 or 7% or dimensional. So I do a lot of different stuff to get a signal.
Well, I think that's a really great methodology, because the more different confirmation, the better and the more accurate. So for anyone that wanted to check out your newsletter, can you tell us how they could find it, how they could get to it for the listeners of the show?
Right. It's www.ord, that's a hyphen, oracle.com. That's my website. We are giving a 2-week free trial, or we charge $60 a month. But if you do during this podcast, we'll double that, make it 2 months for $60. And after a good month or so, you'll understand how I do the market. So because it's kind of once signals, you see a couple of different signals. A lot of them are kind of similar to each other. They're a little bit different because each market signal's a little bit different, but you can see how I layer the signals all in, the multiple signals I layer in.
Okay, so that link will be in the description. So if you're listening, you can click it from the description, or it's ord-oracle.com. You can go there, and then if you mention the How to Trade It podcast, you will get a buy one, get one free month, essentially, right?
Yeah.
So that's a great offer. A lot of good information, probably worth it just for the education, and not to mention the trading side of things as well. So if you're listening, I highly recommend it. Just from being on this interview, I've learned a lot, and I've really appreciated my time here with you, Tim. So thank you so much, and thanks for being on the show today.
Thank you. Glad we'll do it again, maybe.
All right, yeah, we'd love to. Maybe next time we see something crazy happening in the markets.
All right.
But again, just to recap, Tim, the Market Timer, you guys got to go check out his site. Go check out his subscription. He's got a special offer. And we'll talk to you guys later on the next episode of the How to Trade It podcast.
Recording has